You ever see a stock price just jumping all over the place during the day, and you just kind of scratch your head and think, how does anyone actually know what this thing is supposed to be worth? It's a great question, right? Well, today, that's exactly the puzzle we're going to tackle, figuring out the real, fundamental value of a share of stock.
All right, so let's dive right in. Think about it. When you buy a cup of coffee, there's a price on it. A car's got a sticker price. Simple. But a stock, oh man, its value is this constantly moving target. And that's because you're not just buying a slice of the company as it is right now. Nope, you're buying a claim on its future. And, well, the future is what makes this whole thing so incredibly tricky.
And the challenge really boils down to these three things. They make a stock a total mystery, especially when you compare it to something predictable, like a bond. A bond is, well, it's straightforward. It tells you exactly what it's going to pay you and when it's going to stop. But a stock, the cash you might get back, totally uncertain. The company itself could literally last forever. And the return that investors demand, that changes all the time. It's like a giant puzzle where all the pieces keep changing shape.
But, and this is the good news, it's not all just random guesswork. Nope, even with all that crazy uncertainty, there is one single fundamental clue that underpins all stock valuation, and it's called present value. Think of this as our master key, the thing that's going to unlock this whole puzzle.
Now, this concept sounds kind of technical, but trust me, it's super intuitive. Let me ask you this. If I offered you $100 right now, or $100 a year from now, which one are you taking? You're taking it today, right? Of course you are. Because you could stick it in the bank, invest it, do something with it, and have more than $100 in a year. That simple idea, that money in your hand today is worth more than the same money tomorrow, that is the key to everything else we're about to talk about. Okay, so here it is. Here's the big reveal. A stock's price is simply the value of all the cash you ever expect to get from it in the future. Usually dividends, all added up. But, and here's the twist, each of those future payments gets discounted back to what it's worth in today's money. We're basically pulling the future into the present. That's the whole game. Okay, so once that main idea clicks, you can start turning it into actual practical tools. So let's open up our valuation toolkit. Okay? We're going to look at a couple of the most basic models that analysts use all the time, and we'll start with the absolute simplest case you can imagine. All right, just imagine a company that's super stable, super mature. Think of like a utility company, and let's say it pays out the exact same dividend every single year forever. In the finance world, we have a name for this, a perpetuity. And the formula to figure out its value? It is beautifully simple. The price is just the annual dividend, which we call D, divided by the return an investor requires, or R. That's it. Simple as that. But of course, in the real world, most companies don't just stand still, right? The whole point is to grow, and hopefully their dividends grow right along with them. So, what does that do to our math? How do we account for that? Well, this leads us to a much more dynamic and frankly, more realistic model. So let's say a company's dividend grows at some nice steady rate every year. We'll just call that rate G for growth. So to figure out next year's dividend, you just take this year's and multiply it by 1 plus G. To get the 1 for the year after that, you do it again. And this is where you really see the incredible power of compounding. It creates this stream of cash that just gets bigger and bigger and bigger over time. And all that compounding growth leads us to one of the most famous, most powerful tools in all of finance, the dividend growth model. And here's what it says. The price today, that's P0, is equal to next year's dividend, D1, divided by the required return, R, minus the growth rate, G. I mean, just look at how elegant that is. It takes an infinite growing series of payments and boils it down to one clean, simple formula. It's amazing. So let's just quickly run through what each of these pieces means. P0, that's the price we're trying to find. D1 is the dividend we're expecting a year from now. R is our required return, what we need to earn to make the investment worthwhile. And G, that's our constant growth rate for the dividend, going on forever. Okay, let's plug in some real numbers to see how this works. Imagine a stock just paid out a dividend of $2.30. We think it's going to grow at 5% a year, and because it's a bit risky, we require a 13% return. So, first step, what's next year's dividend? We take $2.30, grow it by 5%, that gives us about $2.42. Now we plug it all into the formula. $2.42 divided by 13% minus 5%, so that's 8%. You run the numbers, and what do you get? A value of $30.19. See, the model spits out a very specific price for us. Okay,
But right about now, you're probably thinking of the big, glaring problem here, right? What about all those super exciting, high-growth companies, tech startups and giants that don't pay any dividends at all? They're reinvesting every single penny back into the business. So how on earth can we use a dividend model to value them? It seems impossible.
Well, when there are no dividends to work with, analysts have to get creative. They reach for a different tool in the toolkit. It's more of a shortcut, really, but it's a super powerful one, and you've almost certainly heard of it. It's the price-to-earnings ratio, or just the PE ratio.
So what is a PE ratio? Really, it's just a gauge of what the market is thinking. It tells you exactly how many dollars investors are willing to pay today for every $1 of a company's current earnings. So if you see a stock with a crazy high PE ratio, that's the market screaming that it expects massive, explosive growth down the road.
And using it for a quick valuation is actually pretty simple. Here's the recipe. First, you find a benchmark PE ratio. You might get this from a similar company in the same industry or just the industry average. Then you just multiply that benchmark number by your company's earnings per share. And boom, just like that, you've got a quick and dirty estimate of what its stock price should be.
But here's the really important thing to remember, and what this slide shows so well. There's no such thing as a universally good or bad PE ratio. It all depends. A low PE for a slow, stable utility company? Totally normal. A super high PE for a fast-growing tech firm? That also makes sense. With this tool, context is literally everything.
All right, so let's wrap this up and lock in the main takeaways. What's in our valuation toolkit now? First, we've got the foundational rule. A stock's value is just all its future cash flows pulled back to today. Second, for dividend-paying companies, we have our precision tool, the dividend growth model. And third, for everyone else, we have our handy shortcut, the PE ratio, which gives us a relative value.
And all of this brings us to a final really big question. When you get right down to it, is valuing a stock a science or is it an art? I mean, we've got these precise mathematical formulas. That part feels like science for sure. But every single number you plug into those formulas, the growth rate, the required return, that's just an educated guess about a very uncertain future. And making those guesses, having that judgment, that is pure art. The real answer? The best valuation is always a powerful mix of both.